Howdy, everybody. Welcome to Liberty Call. Today is Wednesday, July 17, 2024. Hope you're having a fantastical day out there. Just got back from jury duty and catching up on things, so I apologize for being a little bit late, and I've got a tickle in my throat, so if I have to pause and cough a bunch, I apologize. So, all right. Well, if it is your first time watching Liberty Call, if you could do me a favor, give me some thumbs up, like, share, subscribe, follow, and press that notification bell. All right, let's go ahead and get into today's numbers. Dow Jones was up 0.59%, 243 points, closed at 41,198. S&P 500 down 1.39%, closed at 55,88. NASDAQ down 2.76%, 511 points, closed at 17,997. The VIX was up 9.78% today. It's at 1448. Canada down 0.63, Brazil up 0.31, and Mexico down 1.15. Over in Europe, Germany was down 0.44, the UK up 0.28, France down 0.12, the Netherlands down 1.81%, Spain up 0.13, Italy up 0.03, Switzerland up 0.56, and Portugal down 0.15%. Russian exchanges both up today. The MOEX up 0.22, the RTSI up 0.44. And in the overnights, the Nikkei in Japan was down 0.31%, Australia up 0.73%, New Zealand flat. In China, the Shanghai was down 0.45%, the Shenzhen Component down 0.47%, China 50 up 0.46%, DJ Shanghai down 0.16%, Hang Seng up 0.06%, and the Taiwan weighted when it last closed on the 16th was up 0.49%. All righty. So kind of a mixed day across the globe. So let's, and even our markets, if you looked at, the the Dow versus the NASDAQ, again today, the NASDAQ is down and the Dow is way up again, like we talked about yesterday, kind of that cycling from growth stocks to dividend stocks or your blue chips. And that's where we are right now. All right, let's get to the market recap. Dow closes above 41,000 for the first time as rotation gains steam. All right, let's get there. All right. The Dow surged on Wednesday, driven by gains in financial and energy sectors, while tech stocks retreated sharply due to geopolitical concerns led by NVIDIA. NVIDIA Corporation saw a significant drop of over 6% amidst fears that the U.S. may intensify its restrictions on exporting chip-making equipment to China. This potential clampdown by the Biden administration, reported by Bloomberg, spurred investor anxiety. Additionally, former President Donald Trump's comments on Taiwan's defense payments to the U.S. exacerbated tensions impacting Taiwan semiconductor manufacturing, which fell nearly 8%. The tech sector felt the brunt of these geopolitical jitters, with major players like Apple, Netflix, and Meta platforms experiencing declines, accelerating the ongoing rotation away from mega-cap tech stocks. Johnson & Johnson, the healthcare giant stock, climbed nearly 4% after it reported a strong second quarter, with both earnings and revenue exceeding Wall Street expectations, driven by robust drug sales. Spirit Airlines, the carrier stock plummeted 11% after it lowered its second quarter revenue outlook, citing disappointing non-ticket revenue. J.B. Hunt, the transportation company stock, dropped nearly 7% following a report of a 24% decrease in second quarter profit and a 7% decline in total operating revenue. And lastly, Five Below, the discount retailer stock fell 25% after CEO Joel Anderson's resignation and the announcement of second quarter guidance that missed estimates. Federal Reserve Governor Christopher Waller indicated that timing for rate cuts is approaching, citing recent data showing that shows a more moderate economic growth and decreasing inflationary pressures. He suggested that while the Fed has not reached its final goal, the moment for a policy rate cut is nearing. Similarly, Richmond Fed President Tom Barkin noted a broader slowdown in inflation, but mentioned the Fed would discuss whether inflation remains too high at its upcoming July meeting. These developments, particularly in the tech sector and Fed signals, are shaping investor sentiment and market movements as the second half of the year progresses. All righty. Let's get to our next article here. Comes from First Trust, June industrial production and capacity utilization. So let's see what is in that data. Industrial production in the U.S. exceeded expectations in June, marking its second consecutive month of growth with broad-based gains across all major categories. The most significant, excuse me. The most significant positive contributor was manufacturing, which increased by 0.4%. A closer look at the details reveals that auto production played a pivotal role in June's growth, jumping by 1.6%. However, non-auto manufacturing, considered a core version of industrial production, also posted a gain of 0.2%. This suggests that manufacturing activity has been broadening recently. Notably, the production of high-tech equipment spurred by the investment in artificial intelligence and the reshoring of semiconductor production has been growing at a 13.3 annual rate over the past 3 months. This trend aligns with the post-COVID shift in consumer preferences from goods to services, leaving capital goods as the main driver of manufacturing activity. Interestingly, demand for consumer goods has also been reviving, with manufacturing activity in the sector up a robust 10.3% annual rate over the past 90 days. This is the fastest 3-month pace since early 2021 during the peak of the lockdowns. The mining sector contributed positively in June, with activity increasing by 0.3%. This was driven by gains in oil and gas production, which offset a slowdown in drilling of new wells and the extraction of other minerals. Additionally, the utility sector, known for its volatility and dependence on weather, also showed strength in June, rising by 2.8%. The recent surge in utilities demand, which has been increasing at an unsustainable 39.2 annualized rate over the past 3 months due to warmer temperatures and higher air conditioning use, is expected to normalize in the coming months. Overall, the continued strength in industrial production highlights a broadening of manufacturing activity and a resurgence in demand for both capital and consumer goods. All right. And now we got some more data from First Trust. This is the June housing starts. This was put together by Nate Gersey. So let's see what he had to say to wrap up the broadcast. June saw a rebound in housing starts, but this increase should be viewed with caution. Although there was a noticeable uptick for the month, the overall pace remains below the level seen from 21 to 2023. The monthly rise was primarily driven by a significant 19.6 jump in the volatile multifamily housing category, while single-family housing fell to their lowest in 8 months. On a positive note, builders focused on completing existing projects, leading to a 10.1% surge in completions to a 1.71 million annual rate, the fastest since January of 2007. Despite this strong completion activity, tepid growth in new starts has resulted in a 6.9% decline in total number of homes under construction during the first half of the year. This trend is often associated with a housing bust or recession. The slow pace of new construction is a key reason why home prices and rents remain elevated across much of the country. It has nothing to do with printing all that money 4 years ago. The housing shortage is compounded by lax immigration enforcement, which contributes to rapid population growth. I bet if you deported the 50 million illegals here in the country, I bet housing would just free up like crazy. Actually, rents would probably go way down. Government regulations and rules are likely significant hurdles for builders, further exacerbated by low unemployment rates, making it hard to find workers, and relatively high mortgage rates. The NAHB Housing Index, which measures home builder sentiment, fell to 42 in July from 43 in June, indicating that more builders view conditions as poor rather than good. This sentiment reflects the broader struggles with the home building sector, despite the growing population and the ongoing need to replace older homes due to disasters or demolitions. However, there are some positive factors for housing. Many homeowners are with fixed sub 3% mortgage rates are hesitant to sell, increasing the demand for new builds among prospective buyers. Additionally, millennials are now the largest living generation in the U.S. are entering the housing market in force, providing a demographic boost. Overall, while housing is not expected to be a major driver of economic growth in the near term, a housing bust like the one in the 2000s is not anticipated either, as the Federal Reserve begins to cut rates, likely leading to lower mortgage rates. Housing may receive some support later in the year in 2024. All right. Well, that is everything that I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information's there. I hope everyone has a wonderful evening, and I shall talk to you again next time. Adios.